to each one of you present here. At the outset, not only me, but on behalf of my distinguished panel, I have to thank all of you for being present here, because it's a big ask to sit like that and listen to us after a lunch session. So please, thanks, and please a round of applause for each one of you sitting here from us. I have an extremely distinguished panel who I'm going to be moderating. All of us have a lot to hear and learn from each one of them here. I have a lot of questions which I'm going to pose to them. So I'm requesting my fellow panelists to try to keep the answers crisp so that we can cover and we can ask all the questions that we have scheduled for this audience to learn here. What we're essentially going to be covering in this panel is enhancing creditworthiness and asset monetization through financial innovation. Well, this must be sounding really daunting, but once we start hearing from our fellow panelists, I think a simplified way of how this is actually being put in practice is going to be something that we're all going to learn from this afternoon. So I'm going to pose my first question to Devendra ji. So Dr. Pant, I would like to ask you, how can states enhance their fiscal credibility and credit rating to access the capital markets in a more effective way for infrastructure financing?
Well, as per the compliance, I will not ask you the answer question directly, but because as a SEBI compliance, we are SEBI regulated entity, we can't say how your credit rating or credit worthiness will improve. I will tell how we look at it and what are the factors we look at while doing. A lot is discussed in the beginning. In the previous panel, we have discussed like how the expenditures rigidities are there. Right? And if you look at Indian public finances by center, state, municipal corporation and all those, it's always the revenue driven. Like the years or the period when we have the higher revenue, we see the better fiscal outcome. Those fiscal outcomes are in the form of, whether you say the deficit, low deficit, deficit is financed, the debt growth is lower. So this comes from the economic growth. So the economic growth is paramount. When we look at it how the state economy is behaving. Improvement in the economic growth will always have the positive feature, or will always give a positive tendency, or what we say in the rating parlance, the sensitivity for the creditworthiness to be better. We look at how the social, physical infrastructure is there for that particular state or the municipality, or even when we look at the sovereign looks at how the physical and social infrastructure is, because that is what the requirement of the state or the government to provide to its citizen. The moment the state start, or any entity, state, municipal corporation, or the sovereign starts working on that, we see there is a positive tendency on the fiscal credibility going up in the eyes of investors. That economy or that state is performing better, and that improves the fiscal credibility. I'll stop here right now.
That's a great perspective. I think just following up on that, Mr. Mohanty, from an asset manager's perspective, what strategies can strengthen the fiscal credibility and make public sector projects more attractive to the domestic and to the global investors?
First of all, thank you so much for including me on this distinguished panel. I think from an asset management perspective, as the asset management business grows in any economy, it starts graduating from one asset class to the other. And when I look at asset management, I look at it from all three parts of asset management, whether it's insurance, pension, or the mutual funds. And what graduated from pure debt to equity with the opening up of REITs and InvITs now gives us this fantastic opportunity to represent the investor for these assets. I mean, let's look at it from a regulatory perspective. SEBI qualify or puts REITs in the equity category and InvITs in the a hybrid category, making it very conducive for us to invest. If you look at the broad investments that have already gone in between REITs and InvITs from the mutual fund industry, it's almost 23,000 crores already. So we are up there, and the recent pension regulations now changed towards REITs. I was very fortunate to be part of the panel which was responsible for including REITs in pension, and that's where the big business lies. Once pension opens up, one insurance monies open up, the kind of investments that can go into REITs and InvITs because of the capital appreciation, the stability of the income, and the possibility of dividends from the nature of the asset class at the underlying level, the possibilities are enormous. So it's just the beginning of the journey. And when you look at this from a Singapore perspective as an example, 5-10 years later, they can form a major core part of our broad investing universe.
Great. We're going to build on the topic that you just touched on, REITs and InvITs, a little shortly from now. But my next question is very related to that, and it's addressed to Mr. K. Mukundan. So I would like to say, what strategic steps should governments take effectively to monetize public assets through InvITs, through PPPs, through market-based instruments, while ensuring sustainable value creation?
Good afternoon, everybody, and thanks to Government of Andhra Pradesh for having me in this event. For a successful monetization or any PPP, there are 4 basic requirements which should be fulfilled by any of the government, whether it is a state government or a central government. The first requirement is there should be a pipeline of investable projects in a sector. You can't have, if you take Andhra Pradesh as an example, you have 1 water project, 1 solid waste management project, 2 road projects, and 1 transmission project. So that doesn't give any scale in economy because we as investors, every investor has a limited bandwidth. To look at one opportunity, we will have to spend a lot of time. If you can bundle projects together and create a big pipeline of projects in the same sector, so that there becomes standardization of our documents, the understanding of the regulations is very clear with everybody, with the investors and with the government. There are learnings. All these projects need not be bundled together in the same project, but you should go by a sector approach. So you can't take sporadic PPPs, will not work. And that's something which we have seen in many of the states. So there has to be a sector-wise approach. The second one, which I would say, is clear documentation and understanding of what PPP means. There is a feeling, now the feeling is going away, but many of the government people feel that PPP means you are privatizing the asset itself. You are not privatizing the asset. You are giving the land for a use by a private developer to develop the asset and give it back to you at the end of 25 years or 35 years. It's a public-private partnership where the asset comes back to the government. So firstly, and therefore the regulations and the rules, regulations and the tender documents have to be friendly and risk-sharing to both the government and to the private party. So the documentation should be very clear, transparent bidding process, stuff like that are required. And standard bidding documents are required. The third one is a neutral regulator is required. Today morning we heard from the madam who was talking about the Hassan railway line. There's a need for an independent regulator. If we have a problem with the government, whom do we go to? We have to go to some regulator, and now we have very good regulatory system in the power sector. We need that kind of a regulator. This is a third requirement. The fourth one is the availability of domestic debt. The Indian infrastructure cannot be funded by dollar debt. It has to be funded by, because the revenues, underlying revenues are going to be in rupees. You need the rupee debt. Therefore, if these 4 requirements are there, I think it will be a successful PPP. And if you see the history of this country, if you take NHA and the power transmission and renewable energy, 3 sectors where huge private money has come in is because of all the 4 conditions which I mentioned.
Because of my personal interest in you not finding dollar debt interesting, I would come back to you a little later. because I represent the gift city and I would love to know why that would not be workable. So we'll come back to that later, but I would like to touch upon from the credit rating perspective. So my question would first be to Ms. Pooja. From a ratings perspective, what are the key factors that determine the creditworthiness of a public sector and infrastructure project, and how can this be strengthened to attract investor confidence?
Okay. Good afternoon, everyone. So quite a relevant question. We have been, since morning discussing on various innovative financing methods, debt management, the fiscal policies. But one important constituent is the credit rating. So credit rating is an important parameter, an important requirement for any kind of debt raising, be it a bank loan raising or a capital market instrument. So from a credit rating perspective, it is important to understand, what goes into rating of a certain instrument or rating of certain bank loan facilities. So here we are all talking about the infrastructure financing. So, from an infrastructure point of view, so I would say there are 4 major constituents of credit rating. There are 4 major risk parameters, which we analyze. Starting with the sponsor risk, the contractual risk, business risk, and financial risk. So since morning, we have been echoing and, we have been hearing a lot on the importance of contractual agreements. So that's quite important from a credit rating perspective as well. So while analyzing infrastructure projects, it is important to understand the modalities of the, model concession agreement, how the concession agreement has been built in, because that goes a long way towards determining the success of the project, the cash flows which will get generated from the project in the future. So as a rating agency, we do look at, how the concession agreements are built in. So for example, if I take up your road, power, or transmission projects for that matter, concession agreements do play an important role. So, it is important, for example, in a power project to understand, the risks related to your environment clearance, forest clearance, off-take agreements. Similarly, for a road project, the ROW availability, or who would be responsible for providing certain approvals, extension of time in a proper manner, the milestone achievement, the structure of annuity. So these are just some of the, constituents of a concession agreement. So in a nutshell, I would say a clear, comprehensive and enforceable agreement obviously uplifts the credit profile of an entity in a long way. So, this is so from an infra perspective, amongst all other risk elements which are important, the contractual agreement is particular to the infrastructure projects. Yeah.
So Mohitji, I think the question is very relevant to you also. Would you like to pitch in and add your perspectives on this from the state angle also?
Good afternoon, everyone. Pooja and Devenji has already put a lot on how the credit rating methodology goes about. I will just add a certain new dimension to it. Okay, see, before that, we'll try to put some numbers on what is the infrastructure need for the country as of now. Roughly around 50 trillion, 60 trillion was spent in India infrastructure capex for 20 to 25 for 5 years. And as per the revised estimates, these are just estimates, it is around 100 trillion to be spent from 2025 to 2030, 5 years. And if we break up into what could be the source of this, roughly central is supposed to contribute around 45 to 50%, state is about to contribute around 30%, and the private around 20 to 25%. So, and again, if we break it into number of debt, the debt requirement for this would be around 28 trillion to 30 trillion. Out of it is expected around 90 to 20 trillion might come from the bank and NBFCs. Roughly 7 to 8 trillion has to be met by bonds or ECBs. So the role of raising the money through these channel infrastructure finance becomes very important. Now to tap the bond market, there has been a lot of perennial issues. First is the investor base. Very limited investor base as of now. And why the investor base is limited? Because it hinges on the credit rating. There has to be a minimum credit rating. Some institution takes very high AA category and above, and all those things. And given the challenges on these infrastructure projects, the ALM mismatch, the long gestation period, it is difficult to get these kind of ratings, and then it ultimately leads to the investor base. So few things, okay, particularly in the area of state finances, uh, has been done is about the credit enhancement, or what we say innovative finance. Uh, and I will be discussing what is already in my public domain, as because as a rating agency we cannot be seen to how to enhance the credit rating, but these are the methodologies which are in our public domain. Uh, so first is about giving certain kind of say Dashra, escrow or waterfall mechanism, which for a particular bond, which is different from the bank loan rating. Here you have certain kind of mechanism where the investors can fall back upon. And the other is PCE. As of now, it is not so much widely used, but very recently the new guidelines has come from regulators about revised framework for PCE, which says about three things. Uh, Improving the investors base. Initially, it was all bankers and mutual funds, but now the investors base can be NBFCs also, AIFs also, and can be the housing finance company. So it adds to the new dimension of the investors. Second, the enhancement could up to be 20% only. Now the can enhancement could be up to 50%. More the percent means more could be the impact on the final rating. And third is what kind of capital weight would be given to this. So now there is also relaxation on the capital weight. So all these things are certain kind of credit innovative mechanism which can lead to innovative finance.
Thank you. Yeah, well, what both of you all said quite aligns with what we are discussing here, and I'm sure that that was a fresh perspective. So, coming to you, Mr. Mohanty, how can the topic that you touched upon before itself? I'd like to delve a little deeper into that. How can innovative instruments like InvITs and REITs actually be leveraged to unlock the asset value and attract long-term institutional capital into public infrastructure, which is what we are here to discuss. What are your actual thoughts on that?
I think the beauty lies in the instruments themselves. Broadly, they give comfort to the investor, and that is most important from an investment perspective. The moment you talk about real estate, the moment you talk about infrastructure, the long-termness of both is known to the investor at large. You don't have to do much selling to them to start with. With other asset classes, you have to talk a little bit. And then it's the progression, like I said, of people investing. It's a great mechanism of using the public-private mechanism for driving the country. And going forward, I won't be surprised if a lot of those monies were to be, channelized through the various forms of asset management, like I said. I personally believe that with the growth of pension, and I do believe there is a lot of emphasis to grow pension in this country. Please understand, and I'll talk about it in my presentation itself, India is probably one of the lowest pension penetrated countries in the world, and there's been enough discussion on that from all the powers to be. Pensions lead investments because the nature of investment there is long. But I do suspect it will be pensions, insurance, and then mutual funds. And all three aspects of asset management will contribute to the growth because the underlying asset gives a lot of strength to the portfolio. What has happened is, unfortunately, this is my personal opinion, REITs is classified only as equity. I do believe that it should be classified across. So actually, it's not impacting because the debt taxation is such that money is not coming to us in debt. But while equity starts buying REITs, debt is actually redeeming REITs. So it's working both ways. But sooner or later, all this will be plugged. And as we progress, it will form a great underlying to our portfolios across asset management, is my opinion. And I see it happening sooner than we think.
Fantastic. So with all this information that we've received, I think we'll have to make an information InvIT so that our hosts here can actually make use of it and utilize these as the probable products of the future. My question now to you is, Dr. Pant, I would like to check what policy and structural measures, according to you, are needed to make asset monetization a sustainable tool for unlocking public value without compromising the fiscal discipline?
Well, my friend has already addressed in his first question, Mr. Mukundan, that you need a list of bankable projects. Now, look at it from two angles. One angle is if you are looking at funding or financing of fiscal deficit, you have a timeline for over a year to get that monetized. But if we see the history of asset monetization, even at the central government level, where it's supposed to be the best, there also in the monetization pipe, they are not able to achieve what they budget for in the beginning of the year. Now, asset monetization should be looked more from a long-term perspective. Though the NITI Aayog has done a lot of study, they have listed number of entities for central government to monetize for asset monetization, because it depends on a lot of things. It depends on what's the market conditions at that point of time, the economy it is in which phase, is it in a growing phase, is it interest rates are way too high, inflation is way too high, your depreciation is way too high. This all, whether we like it or not, these all have the impact on the value of the debt asset to be monetized. Now, when we look at it from the rating agency point of view, like if we are doing some transaction where the asset is being monetized and based on that the waterfall comes or the cash flow comes, at a rating agency, at a rater, we look for liquid asset, not the illiquid asset. So when we say the liquid asset, say for example, an entity who has borrowed has 1,000 crore worth of land, all right? But as a rater, what we have to look at it, we have to look at the timeliness of debt repayment. And if that is 100 crore is to be paid within 1 week's time, it's a big question mark whether the 100 crore of monetization will be achieved in 1 week's time or not. That's why we give more stress on the cash flows, stable cash flows. So yes, you can have a pipeline, you can work upon it, but from our point of view, we three, from which are sitting from the rating agency right at the middle, the liquid assets are more important, timeliness or predictability of the cash flows. Over a period of time, if the projects can be identified and it is not that last minute rush, like January, government wakes up and say, oh, we have to do 10,000 crore, 20,000 crore because we are falling short on the fiscal deficit. Our revenue deficit is way too high. Either cut capital expenditure or do the asset monetization. So yes, they can do, but with a lot of thought process.
That's a lot of food for thought and an extremely practical aspect that you have touched upon, sir. Continuing with my question to the credit rating team sitting here itself, how can credit rating agencies like CARE and Acuité support innovative financing models, such as, again, touching upon InvITs, REITs, municipal bonds, to enhance transparency and actually unlock the value from the public assets? What are your thoughts on this? You know, maybe you, Pooja and Mohit, can share thoughts.
Sure, thank you so much. So, REITs and InvITs, when we hear about REITs and InvITs, the idea that a municipal corporation can also, raise funding via REITs and InvITs is unimaginable. But, so just going to your first question, how rating agencies can help. So, Mr. Pant has already said, SEBI doesn't allow from a regulatory perspective to give us any kind of an advisory. But obviously, a lot of work rating agencies also do in the public domain through their outreach programs, through methodologies which are, there on the website, through the press releases of various entities which we rate. So the risk assessment, the business risk, fin risk, all the risk assessment, all the risk analysis are captured in the press releases. So that is, one aspect through which rating agencies are also helping the entire ecosystem to develop these kind of, financial instruments, which could be used by the governments, by the third tier of the government, that is the municipal bodies. So coming to the second part, what I just started with, the REITs and InvITs. So a lot of is being also discussed today regarding monetization of public asset, what kind of asset monetization can be undertaken. And during the first half of the day, we heard that, AP government per se, the requirement is about 66,000 odd crores, if I remember correctly, to, meet the urban requirements of the city going forward. And there are about, say, 123 odd municipal corporations in the state. So we have also done some kind of analysis, and as per that, about 14 large corporations, based on the revenue surplus, based on the revenue generating capacity, are capable to raise about, say, 4,000, 5,000 odd crores of funding via municipal bonds. Now, apart from municipal bonds, there are a lot of assets with these corporations, the land banks which are there, the commercial properties, the transmission network, the SEZ, the IT parks, which can be converted into a InvIT or a REIT kind of a platform, which obviously, the structure per se, enables them to have a higher credit rating, which is the requirement of the pension funds, the mutual funds, to invest in those kind of assets. So, they can look at their own, assets which can be monetized through these structures and raise finances, which could, partly meet some of the requirement or some of the gaps which have been highlighted during the, earlier part of the presentations today.
Maybe Mohitji can share his thoughts on the same.
I think it has already been covered. Yeah.
Okay, fair enough. I am very quickly, in just 2 minutes before posing my last question to Mr. Mukundan, going to step in because I think we have missed on one of our panelists who was to talk about GIFT City. So just to share a perspective about where and how GIFT City can also play a huge role, and how, how can this be leveraged, this entire offshore jurisdiction that has been created within the soil of India, how can that also be leveraged? As Pooja ji just mentioned, so many municipalities, and so when we as a offshore jurisdiction compare ourselves with other global jurisdictions, we observe that the percentage of debt that our municipalities have raised is close to zilch compared to a huge piece of the pie which is there in other economies. And if we are aspiring to do what we are aspiring to do, then the jurisdiction offers a lot of opportunities and a lot of chances to raise foreign capital. Now, it's not that it is not happening. The regulations are extremely seamless. The investors across the globe are extremely open and extremely forward-thinking towards GIFT IFSC. I would say it's a marathon that we are running, but we have sprinted in that marathon and we have come to the 43rd place. Right now, GIFT IFSC stands as a 43rd International Financial Service Center. And therefore, the perception that foreign investors have in investing through GIFT City is very different. And the credibility and, the entire flavor is that it is an Indian institution raising, but it is being raised from GIFT City. It follows the flavor of our sovereign. At the same time, gives the advantages to, public institutions to raise huge and good amount of debt in form of ECBs from GIFT IFSC. That's just my thought stepping into Ronatji's shoes. My last question to end the panel would be to Mr. Mukundan. So how can innovative instruments like blended finance and credit enhancement mechanisms strengthen the creditworthiness of public institutions to, again, attract long-term capital for them?
Yeah, good question. Blended finance and credit enhancements, obviously, blended finance is a product where one class of investors agree to take a lower return or some kind of with a social objective. They provide some capital to take some lower return and allow commercial investors to come into the project. So to give you some examples, in the earlier days, the solar power projects used to get blended financing. There were some investors who were wanting to promote the solar power projects. Now, actually, where the sectors where blended financing is being worked is hard to abate sectors in green transition like steel, cement, and stuff like that. And therefore, there are a lot of philanthropies and MDBs, which are ready to provide finance at concessional capital, so that on top of that, commercial capital is able to come in on top of it. How it helps, and then the second one you were asking is about the credit enhancement. Obviously, credit enhancement helps in getting a better rating. I guess my colleagues here will be able to tell about that. It will be helping in lowering the cost of financing of the project itself. So I think both the products should be very actively promoted in India. Unfortunately, it has not picked up well. Credit enhancement is something which we have been talking for 15, 20 years now. Since the IDFC days, we have been talking about it. But IFCL, somebody was here, they were also trying to do that, and now I guess NAFID is coming out with a product. There is a big need for credit enhancement products and also for the blended finance products.
Great. So we've kept our time. We've got a big alert here, time's up, but we've kept our promise, and I haven't seen a single yawn, so I think we were good enough, guys. So thank you so much. Thank you for being a patient audience.